breaking news, the US Department of Justice has charged former Coinbase product manager Ishan Wahi and two others, his brother and an associate, on allegations of wire fraud and insider trading today. The Department of Justice called it the first ever crypto insider trading tipping scheme. So Ishan Wahi apparently started working at Coinbase starting in October 2020. As a product manager assigned to Coinbase asset listing team. The DOJ press release says that on at least 14 occasions starting in June 2021 and continuing through April 2022, Ishan Wahi knew in advance what crypto assets Coinbase was planning to list and the timing of Coinbase's public announcements of those listings. He is accused of tipping off his brother, Nikhil Wahi, or associate, Samir Ramani, so that they could place profitable trades in those crypto assets in advance of Coinbase's public listings announcements. They allegedly racked up around $1.5 million in realized and unrealized profits from the trades. And the document says they also used a number of accounts on centralized exchanges in other names, as well as anonymous Ethereum wallets to try and move and conceal the funds. So the whole thing was discovered in an incident back in April when someone tweeted that an Ethereum wallet had bought thousands of dollars worth of a token about 24 hours before the listing was published by Coinbase. The trade was done by Ramani, according to the document, and Coinbase said it was investigating the incident quickly after the tweet. Crazy stuff. So who wants to take a stab at it first? I'm gonna go with Will, because go for it.
No, this is a super wild story. This is breaking news. So I was just reading it for the first time a second ago and like, wow, what a story. So the Twitter account that's associated with this apparently was Crypto Cobain, who now goes as Kobe. He is well known within the crypto space, a pretty big guy at this point, almost going into like influencer / celebrity status for crypto people out there. And he's been tweeting a little bit about Coinbase in their random asset listings for a while now. And this one seems to have paid off bigly. Coinbase has been listing a lot of random assets, like random tokens that nobody quite gets why they're listing them. That's very different from their past, where they were very strict about what assets they were going to list. And in this case, it seemed like they got a little sloppy. They had someone on the team who shouldn't be there, and that person was insider trading as far back or just around the corner, April. That's not that long ago. This was happening pretty recently, and he'd been doing it for quite a while. The story gets really complex. If you go into the DOJ website and read some of the press release, Ramani tried to flee the United States after Coinbase confronted him. He bought a one-way ticket to India. The FBI stopped him before he could board that flight. He sent pictures of all the interactions with Coinbase to the other two suspects, trying to get them to leave, tell them to like flee, go international as well. It seems one of them is still at large and one person has been taken into custody. And they took about $1.5 million in realized gains from all of this activity, which is a decent payoff. But when you're looking at 20 years, which is what the DOJ is pressing right now, not sure it's quite worth it. Jen, to you.
Yeah, $1.5 million between three people in return for 20 years in prison just doesn't seem to make sense to me. What I took away from this story is just how quick crypto Twitter is to identify what's going on in this industry, whether it's good, bad, or ugly. I mean, we talk so much about regulatory clarity, right? And I think that we're going to start getting this clarity in the way that we're seeing this story unfold. I don't think we're going to see, rules written nicely and presented to the industry, and the DOJ or regulators are going to be like, these are the rules, follow them. I think we're going to see people be made examples of, people who are doing shady things, and I think that that's how we're going to get clarity quicker. I don't think that's necessarily the right way, but it really seems like, we're seeing this time and time again. Someone at a large company does something that's not good and they're made an example of, and that's how we know, we shouldn't do that again. Adam?
Yeah, I think it is actually a really interesting story. And one of the most interesting differences, as far as I am aware, is that from this compared to the OpenSea incident that we had a couple of months ago, is that it looks like Coinbase probably actually brought this to the attention of the Department of Justice, or at least, took some action to pursue this. Whereas with the OpenSea thing, I didn't get the vibe from reading the DOJ's release that was the case. I got the vibe more that OpenSea had fired the guy publicly because of the thing, and then they had reacted based on this event happening, but not necessarily at the request of the company. Whereas with Coinbase, it seems like they discovered this internally and then started to take action. And again, if you're fleeing the country, right, that's a bad look. It's not a great way to make sort of your case around all of these things. So
kind of
not great
guilty
there. Yeah, I mean, it's definitely not good. And then the other thing that jumps out at me about all of this is that when we're talking about these types of thefts and stuff like that, look at the scale and the danger that this person put themselves in by doing this inside a centralized company versus, somebody who compromises a smart contract, right? Literally, you can fail at compromising a smart contract and still wind up with a bounty of, $10 million, giving the rest of it back. Whereas these guys, chances are very good based on their behavior and the allegations made so far that they will in fact see substantial repercussions for this. And the dollar amounts are just pennies compared to what we typically see in, a crypto compromise. So I think it's a very interesting story for a bunch of reasons.
Yeah, definitely. I'll pick it up from there. Just to look at the exchange listing process for Coinbase over the last 6 months has been really interesting, really over the entire bull market, right? Just random tokens being listed, and makes you wonder about the internal process here. But Adam, I think you have your finger right on the pulse, correct? They caught this a little bit earlier, and they were paying attention to crypto Twitter as well, which crypto Twitter seems to have this self-righteous tendency to correct everyone as much as it can. And so they were identifying that Coinbase was listing these random tokens. They saw it as an opportunity for someone inside Coinbase to potentially cause harm to the industry. And then Coinbase noted that, looked at the transaction history, and it's all there. It's all on chain, right? It's very easy to look at this. And from there, you can sort of figure out whose wallet is whose, right? It said in the press release that this was an anonymous wallet. Well, nothing's really anonymous with any sort of blockchain application. You can basically figure it out. Just need the address, IP address, make the time zones line up, and things are pretty simple. Sundali, give it back to you for final thoughts on this one, though.
No, Will, that was exactly what I wanted to say, just how crypto Twitter works. And, there's a lot of noise, but it works out sometimes, as this proves. But Jen, you had your hand up, so I'm going to pass it to you before we wrap.
Yeah, just to Adam's point, I am curious I actually think we're going to see more centralized exchanges looking for bad actors internally. I think centralized exchanges, especially in the United States, want to show regulators that they are doing the right thing, that they are abiding by laws, and that they are interpreting the laws that already exist in a fair way. So that should something come up that falls in that gray area that we talk about so often, regulators might be a little bit more lenient with them since they have shown that they are good law-abiding centralized exchanges. So I think, if you're doing something shady and you work at a centralized exchange, probably stop.
Well, it's just not in their best interest, right? Whether you're talking about the OpenSea situation, you're talking about the Coinbase situation, or I would be surprised if there weren't significant shenanigans of this type going on in many other exchanges, because the opportunity has been there and the downside has been very limited. Mm-hmm. But this doesn't benefit a company like Coinbase, doesn't benefit the companies that these people work for. So again, there's a strong incentive for them to stamp out this behavior in as public a way as possible to try and prevent anybody else from doing it.